Okay class, let's continue on with the chapter. Last video we talked about the accounting equation, we talked about transactions and how they all balanced out. We talked about T accounts and we talked about the debits and credits and how every transaction, the debits must equal the credits. Now we're going to move forward and we're going to look at the journal, how we record our transactions, and then the ledgers. Ledgers are similar to T accounts in that they track the balance of accounts. So here I have two ledgers. I've got the cash ledger and the capital ledger. Every account would have its own ledger, but I don't have room to write all of that. So I'm just doing these two ledgers right now to give you an example of how they work. All right? So let's go through three transactions right now. The first one, the first journal entry that we want to put in is the owner investing $10,000 cash in the business. So what we're going to do is we're going to put cash here, and we're going to say contributed capital or capital stock. Okay, there's our journal entry. Now oftentimes we indent it a little bit just because it shows that we have two different accounts taking place here. And the debit would be the cash for $10,000, and then the credit is over here. Now you don't have to indent it, but you do want to always do debits first and then credits. That's just how we do it in accounting. Debits are always recorded first and then the credits, right? So we're going to debit cash $10,000, just like in our T account from the previous video. And contributed capital will be credited. Now this reference we'll use later when we move these entries into their ledgers, okay? The next transaction is, let's say that we borrow $20,000 cash. So cash goes up $20,000, and our note payable goes up $20,000. So we're going to debit cash. Debits increase assets, so the debit will increase the cash amount. Note payable, that's a liability, and we owe that money to the bank, so that's going to increase with a credit. So we're in balance here. We have 30,000 in debits, 30,000 in credits. And see how easy it is to see that we're in balance? Just when you just look at this, accountants can very quickly see the transactions in balance. Hopefully the transaction is right. Doesn't mean it's right, but at least we know that we've done something right, that it is in balance, and hopefully that we have the right dollar amounts and the right accounts here. So like I keep saying, you need to make sure that you keep going through these transactions. Your chapter has lots of examples of transactions. Make sure you understand how every single one of those transactions work, all right? Look over them every single day. I don't think, the first day might take you a couple hours, 2-3 hours to go through these transactions maybe, to make sure that you really understand them. I think the next day, if you look at those same transactions, if you understood them the first day, I think the second day you can probably go through them in maybe 15 minutes to 30 minutes. But you want to keep doing this repetitive thing with them to make sure that you get it in your brain, all right? Let's do one more transaction. Let's say that we're buying a truck, and let's say that we're paying, let's say the truck is costing us $9,000. Let's say we're going to pay $1,000 cash right now, and then we're going to have a note payable for $8,000. So our debit is the truck, because the truck's an asset and we're getting the truck, and I said we're getting it for $9,000, so we're going to put $9,000 there. I said that we're going to pay cash of $1,000, so there's the $1,000 there, all right? And then we have a note payable. We're going to finance part of the truck, and $8,000 is going to be financed. So we have an $8,000 liability. We still owe that to them. We did get the truck that's worth $9,000. How did we get the truck? Cash, and we still owe them $8,000. Okay? So at this point, you want to start looking at the debits and credits and how they work. They're in relationships. That cash went up with the $9,000 here. I mean, the truck went up with $9,000 here, and cash went down with a credit. Okay? So these are on the same side of the equation, of the accounting equation, because this is an asset and the cash is an asset. Those two together get us 8,000 equals the 8,000 there. Okay? If you're looking at the two transactions, if you're looking at the transaction in our formula, our accounting equation formula. Okay. Now these are the transactions that we have in our journal. Okay? The journal tracks all transactions. The journal tracks all transactions. So every time we have a transaction, it's going to be recorded in the journal. So now at this point, let's say I gave you a journal and I said, what's the balance of cash? Well, you could figure it out, but it would take a while. You'd have to go through every single transaction, looking at the debits and credits to cash, and adding and subtracting them. okay? What you really would want is a ledger, because the ledger tracks the balance of each account. Every account has its own ledger. So I have here, like I told you earlier, the cash ledger and the capital ledger. So the cash ledger, we're going to put a date here. On January 1st, we had cash going up 10,000. So you could write in here cash going up. A lot of times people just leave it blank and they just put the balance in here. So it would be 10,000 here. And our running balance for cash is 10,000 at this point. Okay? Our next transaction, our next part of this transaction, oh, I forgot the reference. Okay, remember I said there's a reference. This, let's say this is the first page of the general journal, so I'll just put right here, page 1, okay? So the reference is just saying, where did this dollar amount come from? Well, it came from the general journal. Now some people will put G, some people put J. I'm going to put J because I call it the journal, J1. Some people put G1. You can put anything you want as long as you're consistent. But usually the most common are either J or G. So this is saying that this 10,000 came from the journal, page 1. Over here they have a reference too. You're saying where this is going. Well, this is going to the cash account. The cash account is account 101. So we're going to put 101 as the reference. So we cross-reference everything so we don't lose things, so we know what happens. Because you wouldn't want to look at this transaction and say, where did it come from? We know where it came from. It came from the general journal, page 1. The capital. In this transaction, we had 10,000 of contributed capital, so that increased. So this is going to our capital account here, which is account 301. So we're going to put down on January 1st, hope you can see this, January 1st, explanation, you could write in there, owner contributed money, just like we could have done that here, owner contributed cash. It's a 10,000 credit, so we're going to put 10,000 there, and the balance is 10,000. Okay? Now notice, the balance shows that it's a positive dollar amount. Whatever's the normal balance for that account, then it would be a positive. So the normal balance for a capital, contributed capital type account or capital stock count is a credit balance. So this 10,000 running balance is just telling us that is the normal balance for this account. Just like the cash, this 10,000 is actually a debit. But since we're looking at cash, we would expect to see a positive 10,000 or a positive dollar amount, unless we owed money to the bank. But in this case, we have a positive 10,000, so the balance is going to be 10,000. Let's look at just the first part of the next transaction, just to see how this one's recorded. It's cash going up 20,000, so we're going to reference that to 101. I'm going to put down here the date, January 2nd. It's coming from journal entry 1. Oh, I didn't finish this one. I need to put that reference in. Journal entry, page 1. So this is journal, page 1. And it's 20,000 cash. Cash went up 20,000, so it's this 20,000 here. It's a debit, so we're just moving it into this ledger. And then our running balance. Well, we had 10,000. Now we're adding another 20,000, so that's going to be 30,000. Now let me point out that you would do the same thing for notes payable. There would be a ledger for notes payable. I just don't have room for that on the board. But there would be a ledger for notes payable, and you would move this into notes payable. There would be a ledger for truck, and you would move that into the truck account. This cash, well, we already have this one. This would be put in here. In fact, let's do it. 1, 2. It'd be coming from journal entry 1. Cash is account 101, and it's a reduction of cash because we paid $1,000 cash for the truck. So it's 1,000 under the credit. So now our running balance would move down to 29,000. Okay, and then lastly, this note payable, it would also go to our notes payable, a ledger account under notes payable. Okay, so this is how journal entries and ledgers work, the interrelationship between them. Your textbook, once again, has fantastic examples of all of these transactions similar to these, and then they show them done in the journal, and then they show how they reflect in the ledgers also. All right, good luck, class.